All right, why don't we talk about gold? As you can imagine, being on the safe money side, helping people with that portion of their portfolio, the question of gold comes up a lot. And why don't we go through 5 ways a person can actually obtain gold and talk about the pros and cons of each of those 5 ways. But before we do that, I think it's important that we talk about how gold is priced. I could do an entire video on how gold is priced, and you still wouldn't get much more out of it than the very simple, short explanation I'm going to give you here. So there are 2 ways gold is priced. There's a fixed price, and when I say fixed, literally it's a fix, meaning at 10:30 and 3 o'clock London time, Greenwich Mean Time, over in London, there's a conference call, literally a phone call of the LBMA, which is the London Bullion Market Association. And there are 5 market makers that represent them. Now, the LBMA is the top 100 plus of the largest banks, financial institutions, gold stakeholders. And the 5 market makers literally get on a phone call and they take all the interest from all the different members in order to determine a price that will allow the greatest number of buy and sell orders to be filled at that moment. So that's done twice a day. Then there's what's called the spot price, which is generally, if you're surfing on the internet, this is the number that you're going to get. And the spot price is what gold is trading at the moment. And obviously, at 10:30 and 3 o'clock, the spot price and the fixed price should be pretty dang close to each other. But in between these periods of times, there's going to be fluctuations. So if this is 10:30 and then this is 3 o'clock, that price is going to do this. It's going to fluctuate, and then it'll be reset, and then it's going to fluctuate again. So it's going to do that. And these fluctuations represent the futures markets and general reactions throughout the day. So why don't we take a look at a current quote. So here you can see today, it's Halloween, October 31st, 2013. So the New York time is almost 11 o'clock. So here's the 24-hour spot gold bid. And this particular graph shows you that the last bid is 1,325, and it shows you what it closed 2 days prior. So here's the current spot price right there. So if you just simply Googled gold spot price, this is a typical graph and quote that you would get. Now, before we jump into the 5 ways you can own it, let's have a little fun and just talk a quick history. I should probably do a series of videos just on the history of gold, because it's really quite fascinating for not only economic, financial reasons, but for geopolitical reasons. So why don't we just look at a chart here. So this is, as you can hear right here, the London PM fix. So this is a chart that shows the PM, that means the 3 o'clock price. So that's the last price per day. So this is the London PM fix from 1975 to present. So here we are, 1975 is over here, and present, this is up to literally yesterday. Why didn't I show you a chart pre-1975? Well, that gets into the history of what went on. There's a lot of world history that is gold, and when you study what happened in World War I and World War II, it's just incredible the dynamics that went on there. But let's just quickly focus on the U.S. In 1900, the U.S., they actually had the Gold Standard Act that was trying to regulate gold and gold pricing. But this was done away with in 1933 by Roosevelt, when Roosevelt made it illegal to own gold, literally. Then in 1946, there was a conference held a couple years prior in Bretton Woods, New Hampshire. The Bretton Woods settlement actually determined that the price of gold would be fixed at $35. So it was a fixed exchange rate that allowed governments to sell their gold to the U.S. Treasury at a fixed rate of $35. Then in 1971, Nixon took us off the gold standard. And so that's why when we look at this chart, prior to the left of this, gold was at 35. And then it was being able to trade freely, and you can see how it started moving. Now, this is interesting. It jumped up in 1980 and it came back down. So there was a lot of things going on here. We had incredibly high oil prices. This is when Russia invaded Afghanistan. This is when the Iran hostage crisis occurred. But one of the biggest factors is the Fed, through Paul Volcker, the chairman at the time, raised the Fed funds rate from 13% to 20%. That was an initial shock, and then as you see, it came back down. And then it kind of stayed in this range for quite some period of time. And then in the late 90s and early 2000s, it started going up as people started losing confidence in currency, not only in the United States, but across the world, as the dollar started devaluing. And as we started seeing not just regional geopolitical issues, but when we started seeing global catastrophes such as 9/11 and other issues, and this you can't go a day or a week now without finding some interest in gold, and the popularity is certainly driven, and this is a perfect example of supply and demand, right? So why don't we jump into the 5 ways, the major ways that you can own gold. So the first way is to actually have direct ownership. So whether this is a gold bullion bar, or most people own coins. The most popular is the South African Krugerrand, but you can also get Canadian Maple Leafs and American Eagles, and there's a bunch of different types, but these are literally 1 ounce gold coins. If you have a local dealer that you can literally walk in the door, give your money, and walk away with the gold coins and put them in a safe in your house or safety deposit box or whatever you want to do, or you can go to the many online dealers and they would send you the gold in certified mail. It's it's very safe. I've done it, and there's no issue of hey, what happened to my gold, right? So the pros and cons. So the pro of owning direct gold, I'm going to say, is the most obvious pro I'll mention is the physical, that you can actually physically own or physically hold the gold. And with that comes security, that if you are focusing on this from a government or geopolitical issue and you want to actually own this, then that's the pro there. The con, I will say, is probably number 1, the spread, because you're going to buy it retail. So you would buy this at retail, and when you wanted to sell it, you would sell it at wholesale. So that spread is generally pretty wide. It's going to be the most expensive of any other transaction way of buying gold. If you are looking to make money on gold in the short term, this would not be the way to go, because the gold price would have to have a pretty significant move just to make up your spread there. Okay. The second way to buy gold is through an ETF, exchange traded funds. Quickly, what is an ETF? If you're not familiar, there is an index. So you can buy the S&P 500 index, which is a fixed index of 500 stocks. And all you're doing is measuring what those 500 stocks do in aggregate each day. So they're either going up or they're going down. So that's an index, and an index is traded once, and it has a one day closing price. Now, the opposite of an index is a mutual fund. And a mutual fund may own all the same stocks that are inside this index, but the mutual fund manager, is constantly buying and selling stocks. So he's constantly taking some stocks in and putting some stocks out. And the mutual fund as well trades at the end of the day. Now, an ETF, which is a fairly new, when I say new, it's been in the last 15 years, instrument, it works like both of these. Number 1, an ETF has a fixed holding inside. If it's stocks, it's a fixed set of stocks. It's a basket that is not traded by a manager. It's fixed. But the interesting thing about an ETF, like an individual stock or bond, is it trades intraday, meaning you don't have to wait till the end of the day to get your price. You can buy and sell it throughout the entire day. So ETF. And as far as gold is concerned, with an ETF, the ETF is buying individual gold stocks. Now we're going to get to another way of owning this. It's the third way of owning gold, which is individual stocks, the stocks of gold mining companies. But in this ETF, they're going to hold a fixed number of gold stocks. If you wanted to just look up, I'll give you some symbols here. So you can look up the GLD, which is the State Street's gold ETF. And then there's another one, there's the IAV, which is a precious metals ETF. So this one is the iShares ETF, and it has gold, but it also has other precious metals in it. So literally, this is a ticker symbol that you can type in GLD, and you can see how it's traded intraday. It's traded just like a stock, but it's a fixed basket within this. So pros are obviously liquidity, and I'll also say efficiency, meaning you don't have a big pricing margin to buy an ETF. It's much more efficient as far as cost goes between the retail and wholesale price you would get on direct. The con is, I'll just simply say that it's not managed. If you need help here, that predicting what's going on, then an ETF is nobody's going to help you with that. Let's drop down to the individual stocks that we just introduced. Now, I'm gonna break this down into two categories, and that is there are senior gold stocks and there are junior. So a senior gold stock, this is a company that's large. It has its own mines. It has proven ability to produce known quantities, and it has a profitable track record. Companies like this, I'll just give you a couple ticker symbols you can just look at just so you understand this. So Newmont Mining, NEM, you look up that ticker symbol. This is a Colorado company. They have proven and probable gold reserves of over 99 million ounces. And they have land possession of over, I think it's 29 or 30,000 acres, square acres of land that can produce gold. They can be mined for gold. Another company, huge company is Barrick, ABX. Now they do a lot more than gold. They do silver and copper, but they have 140 million ounces of provable and probable gold reserves. But they, like I said, they do a lot of other, I know it's silver and copper. Then there's the junior gold stocks. Now, as you can imagine, these companies are smaller in overall size. They either don't own productive mines or they may be exploring. And you can have, there's obviously a much greater potential for profits, but there's also a greater risk of loss. And anytime you hear about somebody just making a killing, a big gain in a individual gold stock, it probably came from one of these junior stocks. So the pro is you're going to capture any growth trend going on inside gold, right? And you're gonna probably, it's gonna be a wave, right? So if gold is going up, you're on the positive side, then you're gonna be able to capture that at most likely some X factor on the way up. The con is that if the trend is up for gold overall, but there's some kind of issue going on with the individual company for whatever reason, and that is suppressing the ability to capture this wave, or actually the company itself is having significant problems, and that's a risk, and your value could actually go down when gold itself, the trend is actually going up. So that's certainly a con. So let's go into the fourth way, which is a mutual fund. Now, we talked on a lot of this earlier, but a mutual fund, we're literally going to have a money manager that's going to be buying these senior and junior gold stocks. Now, you're also going to pick up a lot of other precious metals, silver, copper, platinum, and so forth. inside these because there's just not that many pure gold, individual gold stock companies. So you're going to, so that leads us to the pros. So one of them is, diversification. So your diversity of the individual stocks. You want to own individual stocks. You just don't know which one to buy. You can get the diversity of that and also pick up other precious metals. That's what you want to do. Now the con is also this business risk we talked about up here. There could be one poor performer out of all these that could drag down your overall performance. Now, generally, most precious metal mutual funds, their top 10 holdings, their top 10 generally represent 60+% of the overall portfolio. And the other 40% are made up generally of the juniors. So the top 10 are going to be the bigger senior gold stocks, and then they're going to fill in with all these other juniors. And that's fine. And if it's a great manager and he's smart, you could do very well. But just remember, one poor performer, and it could not only eat up any positive return, but it could actually spin you off into negative land, which is never fun. The fifth way, let's go to the fifth way. The fifth way is options and futures. This is for the very sophisticated. This is not for the lighthearted by any means. Quickly, if you buy a call option, what you're hoping is that the price of gold will rise, meaning that your option is at 1,300, and that's what you're able to buy it for. And then let's say it's a 6-month option. 6 months later, you're hoping that gold goes up to 1,400, and then you can make your call. You exercise your call at 1,300, and you make this spread right here. If you think that gold is going to go down, then in that case, you would buy a put. Now, the pros to using futures is you control a large investment. You control a large investment with a very small amount of money, right? So this is the epitome of leverage. The cons are obviously, and I know you're going to see, well, you can lose all your money. I'm going to write this word down so you understand. The biggest con to option trading of any sort, whether it's stocks or precious metals, is time, because time is your enemy a lot of times. If you have, let's say you're buying a call and the price is set at 1,300, and this is a 6-month call, you have to hope that this price happens in that time period. Because if it's hovering around 1,300 and at the 6-month point it doesn't move up, and then sure enough at the 7th month point it makes its move, it doesn't do you any good because your option already expired. And just so you know, easily 3/4 of all options expire worthless. Okay, so I hope this helps going through all this, because it's certainly difficult to turn the television or radio on without hearing something about gold. And I hope this video has helped you understand the pricing, the history, and the 5 different ways to invest gold. If everything that glitters is gold in your eyes, go buy yourself some gold, okay?